You did it. Okay. Thank you. Okay, so for those that don't know me, let me start with an introduction. Can everyone hear me okay? Is it okay? Tell me if it goes bad. As I said, I'm back in the office and the Wi-Fi is worse than my house, so I'm not going to do this again. But let me just introduce. Okay, so I'm Lizzie. I'm actually on the board of India Quotient, believe it or not. That's my proudest part of my bio. And I've known the IQ team for like God, more than 10 years, actually, maybe 12 years. So I'm really old. I've been working in and around India and fintech for more than 10 years. And before that, I was actually on your side of the fence. So I was a investor for a big endowment in the UK. And I was covering direct financials investments, public and private. Before that, I was a banker, or I worked at Goldman in equity research and then asset management. So quite a boring traditional sort of background. But what's more interesting is I obviously fell in love with India. I'd always had a sort of passion as a youngster. I watched a lot of Bollywood films growing up, believe it or not. They were cheaper than American films. My mum's really cheap, so she would only let me watch the cheapest films, 2 for 1 on Bollywood. But no, seriously, I just always found India fascinating as a culture and a country. And then when I was working in financial services and studying global banks around the world, it was so obvious that India was going to go through the most amazing market expansion, value creation in the next decade. And I just wanted to be part of that. And I didn't want to be a bystander. I wanted to actually be part of shaping that. Because I had pretty clear ideas of what the market needed. And some of it comes from looking at traditional business models. So I've been a big believer and investor in a lot of NBFCs in my time. And I love companies like Bajaj Finserv. So there's a healthy dose of respect for traditional financial services companies. But what I love and understand is tech and digital. Me and my 2 co-founders met in London. We were working together since 2011 in a company called Wonga, which was at that time the kind of sexy unicorn of Europe. We were $1 billion company, which in 2011 was like being a $10 billion company today or more. We were the largest and most successful digital lending company at that time, maybe globally, actually. And I remember Anand was always impressed by our revenue per head count. We had 12 million customers in 8 countries. And when I joined, there were 40 people. So I really saw the true power of technology in digital financial services and how you could make a massive impact at scale quickly. And that's what I wanted to translate to India. So me and Priya became the Wonga India team in 2012. We ran around India trying to build the first pay later product back then. So the truth is we have been in pay later for more than 10 years. And people think BNPL or pay later just happened in the last 12 months. 10 years ago, we were selling it to companies like Flipkart and Make My Trip in India. So we are the OG. We've got the longest history, but lots of learnings as well. And I think the truth is we were too early and now is the right time. So we're really excited about the next couple of years. I'll just quickly give you a bit of background on like, what is BNPL? Why is the world going gaga over it? I'm guessing, given what you all do, you know this. I don't need to spell it out, but it's very generational. The point about BNPL in the rest of the world, and I'm talking mostly about Western countries, so US, Australia, Western Europe, is that young people are increasingly turning away from credit cards. It's a massive cultural trend. I think the internet is driving it. And that's because in every other aspect of a young person's life, they now get complete transparency, right? So you can get complete transparency over your dating life, over your learning life, over every part of your life. And then you go to the financial industry and you get these horrible products with hidden fees, traps. The entire credit card business model is a very cynical, hidden fee business model. And so young people are increasingly saying, I'm not going to use these products. I want transparency. I want control. And I want a product that's better for me. It's like a healthier product. And that's what BNPL is. So what you're seeing is customers literally ripping up their credit cards across the world and pushing their entire shopping behavior towards BNPL programs. That's kind of well known. I think now we've got some data. Here you go. You can see, I love this. So number of credit cards per user. This is in the US, that chart on the left. Gen Z is like 1.8 versus 4.8 for their parents. So it's that dramatic. And by the way, this is not a supply problem. It's a demand problem, because in the West, and I can verify, and if any of you went to university in US or whatever, you're literally given a credit card as soon as you can sign your name, right? The credit card industry is extremely adept at pushing its toxic product. So all these big companies like Klarna, Affirm, Afterpay, Zip, Sezzle, these are some of the biggest global highly valued BNPLs, are profiting from this shift. But I think the bit that a lot of people ignore, and this is the key point. If you remember anything else today, I think this is like one of the main points. But why did BNPL suddenly explode in the last, say, 3 years? Why did the volumes come from nowhere, right? So 3 years ago, by the way, Klarna was not a massively valuable, famous company. It's probably going to IPO at $100 billion next year. But like 3 years ago, it was just crossing $1 billion. And same with Affirm and these guys, right? They've had their ups and downs. But in the last 3 years, BNPL has exploded and valuations have gone up with them, like ridiculously. A big part of it is this. What BNPL did is take a traditional credit business model, because at the end of the day, this is credit, and I will talk more about that, took a traditional credit business model and gave it a revenue profile that looked a lot more like a SaaS enterprise business model. Because the incredible secret of BNPL is most of the fees, most of the revenue are paid by merchants, brands, or retailers. So BNPL was the first credit business model that managed to hack a diversified revenue model by getting paid by the brands. Right? So most of these brands, whether it's Affirm, Klarna, Afterpay, Zip, Sezzle, 60 plus, sometimes 80% of their revenue is coming from Peloton, Amazon, et cetera, et cetera. That makes investors go gaga, because it's considered much more stable, sustainable revenue compared to traditional credit models that always have that cyclical boom bust credit cycle behavior. So in a very cynical way, you could almost say BNPL is, what do you say, old wine in a new bottle. It's just consumer digital lending repackaged with an improved business model that gives a much more predictable, sustainable kind of revenue outlook. Does that make sense? And I'm being obviously I'm giving you the kind of, the reality check viewpoint. Obviously, we do believe that there is a big consumer, drive behind this. But what explains the massive re-rating and valuations of these companies is more than just the consumer demand. It's the fact that they've managed to create a product that sells to retailers, brands, and e-commerce platforms. And obviously, as there is so much liquidity in the world right now, and companies like Peloton are able to attract that liquidity, a lot of that comes downstream to the BNPL. So another reason investors love BNPL is it has that picks and shovels nature when you're in a kind of global tech explosion. Right. So that's kind of a VC's view. But let's flip to India, because that's more interesting. So we have this counterpoint. We actually think India is already probably the biggest BNPL market in the world. And that's because India already runs on credit, right? Whether you've formalized it or not, whether you've created a product around that, the truth is every supply chain, every retailer, even every service provider in this country gives basically credit or delayed payments, right? So whether it's your local grocery store, whether it's your travel agent, whether it's your maid, you can always pay later. So this is a country that already understands pay later. We never demand upfront payment for anything. And we work on a delay payment mechanism. So we think that already India has the characteristics of a perfect BNPL market. All that's needed is the formalization of that. And companies like Bajaj began that journey 15 years ago. So way before Klarna and Afterpay were as famous as they are. Bajaj, by the way, has 24 million customers today, which is the same number of active users as the entire credit card base of this country, right? So if you add up all the credit card active users today, it's the same as one BNPL company, Bajaj FinServ. So we have good reason to believe this is already going to be the biggest market. Obviously, BNPL has to be digital and it has to be automated. And so you have to now look at what are these amazing, tailwinds that are driving the interest in BNPL right now in India. It's the fact that we are becoming the most digital consumer base on the planet. And so I don't need to tell you guys this. You guys probably make these slides all day long, right? The pitch to LPs, the pitch to the world is India is the fastest growing, youngest digital consumer. But more than that, we have a complete absence of banks catering for the young mass market digital consumer. So already, thanks to people like Google Pay, Phone Pay, and obviously Paytm, consumers in India use non-bank apps more frequently than they use bank apps. So you don't even have the competition that you would have in Australia of a credit card bank app, right? So already we're in a stronger position where consumers are adopting fintech apps faster than anything a bank puts out. UPI has just been the ultimate proof point that you do not need to have physical presence, physical infrastructure, physical cards to grow, massive volumes. Consumers are already ready to adopt a completely digital product. Look at this chart on the right-hand side showing debit card usage, credit card usage, and then UPI. Basically, cards are a flatlining product in a market like India. There is no need for them. I worked for a stint in DBS and tried to build a digital bank for them. And I learned the costs of running a card program, a physical card program. It's insanely expensive, right? If ever you go to an ATM and the ATMs that have air conditioning and a guard with a gun, think of all the costs, all the fixed costs that are going into a card program. So UPI has proven that you need zero physical infrastructure to deliver outstanding payments experience. And BNPL is just the credit version of UPI, if you think about it. And if you stick, a BNPL product with a UPI front end, you've got something way more powerful than a credit card that's already distributed. So just to put the numbers out there, this compares the biggest markets in the world for BNPL products with India. We have a bigger potential TAM. It's completely underpenetrated. We have literally less than 30 million unique credit card users. And good data point for the females here. We have less than 1 million women using credit cards in this country. I mean, that's just astounding. Less than 1 million women use credit cards. And BNPL is loved by women more than men all over the world for some reason. So you can just see that this can be a really, really killer value proposition for the India market. That's why we're so excited. And you can say, look, the timing is right? We know that credit is massively underpenetrated in this market, but we know that consumers are ready to spend. They have the desire, they have the ability, they have the infrastructure, but guess what? They don't have the income because GDP per capita is still where it is. And so because of that, there is an argument that small ticket consumer credit products are about to really, really expand. This is another way to put that, which is, young people, the Gen Z population today in this country still wants to buy exactly the same products and services as a kid in Australia, right? They want an iPhone or they want a great smartphone. But guess what? They don't have the income to match that. And an iPhone actually costs more in India than it does in Australia. So if you're going to assume you're Apple and you want to penetrate, the mass market of India, you have to provide affordability solutions. There is no other way to grow the market of many, many products today. So we believe that there's even more potential in India to get the brands to pay for distribution and subsidy of these products. Just to put it another way, if you look at the entire customer base of Bajaj, SBI cards, HDFC cards, so $200 billion of market cap today is basically about 30 million people, right? Or 10 million households, maybe 20 million households. Can you possibly say that there aren't another 100 million households that could use a credit product if it was tailored with the right distribution cost, operating cost, etc. And that's what BNPL is. So it's truly a mass market potential consumer credit product. And that's not even going down to the bottom of the pyramid. We're not talking here about, rural microfinance, etc., etc. We're saying there's probably 200 million households today that already have income to support a small ticket BNPL. And then finally, we have the picks and shovels argument here as well. The more capital that comes into the market, the more money that goes into all the logos you see here on the right-hand side. And I'm not just talking about startups and VC funding, even the fact that Apple, Samsung, all the big global brands are now desperate to crack India, and more desperate than ever because China is harder than ever, right? You're just seeing so much potential GMV expansion over the next 3 years. And we are on the front end of this. We've been running ZestMoney for nearly 6 years. We've been in BNPL for 10 years. And I can tell you that in the last 6 months, I've never seen so much desperation from brands to get BNPL live. They need it. Because again, and I can't emphasize this enough, GDP per capita in this country is not expanding as fast as consumer demand and capital to fund that demand. So credit is the need of the hour, and the brands understand that. So if you just believe that these brands are going to continue to grow, then you have to believe that BNPL will be part of that journey. And then final kind of proof point if you needed it, but credit card just hasn't worked in India. There's no other way to put it. Credit card is an outdated product. Banks don't like to issue it. Customers increasingly don't want to take it out. You only have to look at these kind of pathetic numbers. And so we think there's even more reason for a fresh, new, exciting model. You might say, well, what about debit card EMIs, credit card EMIs? They just are awful. If anyone's ever used one, you will know what I mean. It's a horrible user experience. It's the worst of like hidden fees, opaqueness, lack of transparency, complete confusion. So they haven't taken off. It's no way to put it. I'll give you the numbers. So Bajaj does about $7 billion of GMV per annum in this country, one company on one product, which is their EMI BNPL product. The entire credit card EMI GMV is about 4 billion, right? Which is, quite small. And then debit card EMI has been a complete failure. There's no two ways about it. And we are just one tiny company that's not even raised much money. We're not even a unicorn. And we've already done, more GMV on an annual basis than the entire debit card EMI market. So the potential for a BNPL company, we think, really even just to be a digital Bajaj is immense, and it's all going to happen in the next couple of years. We think there's going to be quite a few winners in this space. You might ask, because VCs always do, we get asked this question all the time, won't Amazon and Flipkart just do it? And the answer is, yeah, of course they will, and they have, but it hasn't scaled. It hasn't broken out. So Amazon and Flipkart do relatively small volumes. On a GMV basis, they're smaller than Zest, both of them. They've touched more customers because they do a more small ticket product, and we can talk about that, the different types and flavors of product. But from a GMV perspective, it's not been a roaring success. Now, we believe that captive BNPL programs will struggle to scale in this market. Customers are not loyal to any one brand in e-commerce, as you probably know. So the same customer that switches between Amazon and Flipkart is also going to be basically disloyal to the BNPL that they offer. And customers really want open loop programs, or at least a diversified network model. Also, and this is the boring bit, but at the end of the day, the winner in any credit product at scale is the player who manages their credit risk and balance sheet most effectively. And nowhere in the world is there evidence that a retailer is better than a pure play financial company at doing that. Best example, Chroma. If you've ever walked into a Chroma store, you would be forgiven for thinking it's a Bajaj shop. Why is it not Tata Capital, which is a Chroma brand, right? Chroma sister company funding all of that. If it was so easy for the retailer to do its own financing, then you wouldn't have Bajaj in that monopoly position. So at the end of the day, lending is lending. It takes focus, it takes dedication, and the jury is out that somebody like an Amazon can never do that at scale in a market like this. Global guys have really struggled in India. They've come, they've gone, they've got shut down. We truly believe it will take a domestic player to be the winner. But we do think there will be a few of them. It's such a big market. In lending, it's never winner takes all, especially in India. You cannot be all things to all people. There will be different segments, different flavors. We think there's probably going to be 10 multi-billion-dollar BNPL companies in the next 5 years. Today, probably 0.1% of e-commerce volume goes through BNPL. It's 25% in some Western markets. So that's how much, the pie is going to get bigger, and everybody's share of it will continue to grow. Quick primer, how to spot a good BNPL company. I hope that's what you've all come here today to learn. Here's the checklist, slightly biased, obviously, but I'm going to anyway give my view of the world. Number one, and this is really important, there have to be network effects in this business. Again, the reason people like Afterpay and Affirm hit that breakout velocity in the last 2 years was because they'd spent the previous 4 or 5 years building a merchant network and deep relationships with merchants so that merchants push the product to their customers. We believe that's an essential component of this product. You cannot build a standalone consumer BNPL easily at scale. It's too expensive. The margins are not in it. So you need a merchant network support to drive your profitability and, in the end, your customer acquisition and network effects at scale. And we'll talk about that if that's useful. We also believe in India that this is one of the most complicated, heterogeneous markets for the consumer anywhere in the world, because of people's different levels of affordability, different tastes, different behaviors. You need a very complex product suite. It cannot be a one-size-fits-all product. And that's obviously what we offer. We also believe that you have to be the best at lending. There's no shortcut. Lending is lending. It's painful. It's ugly. There's collections involved. And so it's really, really, really important that you crack that at scale. And even people like Paytm have so far struggled to do that. So it's not just a capital game when it comes to lending and lending sustainably. You have to make money. This is a thin margin product. It's very difficult to charge the customer. So you need to have a strong revenue profile that scales well. You can't just drive this like a payments business because there's credit involved. And then you have to figure out your balance sheet. And that is crucial. Anybody can scale to a certain level, but in lending, the name of the game is a constant supply of affordable capital. And then finally, if you get all of that right, your economics will make sense and you'll make loads of money. And that's what we all should be doing in the long run. So this is the flywheel. This is the network effect. The idea is that the more customers you have, the more merchants will need you. The more merchants need you, the more they promote you, and that brings you more customers. So you get to this really powerful kind of velocity. The more this flywheel scales, the cheaper your operating costs, cheaper your CAC, cheaper even your credit costs, because the more ubiquitous you become, the better behaved your customers are because they want to use you everywhere. So you see with somebody like Klarna, as they scale, their credit costs just come down and down and down and down. Now, you might ask, are they not profitable? But very few BNPLs in the Western world are profitable right now. And that's because they are all deliberately focusing on growth and market expansion. I think in India, we don't even need to be unprofitable. There is enough margin in the business and there's enough demand that we can actually create profitable BNPLs quite early on. And again, it's back to this point, the merchant needs to love what you do and they need to pay you for it. And we are very proud at Zest that we have some of the highest merchant take rates in the world, actually, in BNPL. So, make sure the merchant loves you. How does the merchant relationship work in BNPL? It's not just that they pay you like a payment product, they also promote you. And this is a really, really key part of the business model. The fact that we get 160 million monthly impressions because of this is what makes us strong and what makes our business model work and why we don't have to burn money. We've got our logo obviously everywhere on the merchant partners we work with, but they even push us out. They do marketing, they do branding, they do promotions. At the moment, we are live in Reliance Digital physical stores across the country, and Reliance is funding a 10% cashback on all our transactions. That is the power of a good BNPL, because if Reliance are actually believing in what we do, so much so they're funding a 10% cashback. Think of what that means in terms of our revenue profile. So I think this is really important and sometimes get missed at the moment because it's so easy to just pay money and acquire customers. It's not so easy to get merchants to acquire customers for you. And then this was the point I said about having a range of different products. So this is probably a question I'm sure you have, but you know, what is BNPL in India? It's got so many different flavors and varieties because of the diversity of different use cases that we have. We would argue that the small ticket, short-term BNPL products are some of the hardest to make money on a standalone basis. Both the merchant and the consumer doesn't really want to pay for that, but we do operate that product because it's a really powerful retention tool. So once a customer's come once for that product, he'll come multiple times, and then you might use other flavors of your product. To be very honest, where we make the most money, and obviously where brands like Bajaj make the most money, is in the bigger ticket segment. So that middle segment, particularly in things like electronics, where in some cases we have brands paying us 24% subsidy, like 24% take rate effectively. So, you know, you have to have a mix of flavors, we believe, to make a profitable business. If you're just going for metrics like, you know, number of users or number of transactions, then it's probably easier to stay at the small ticket short-term end, but you will then be competing with UPI, wallets, Google Pay, and it's going to have to be a cashback game. So we would say that's not really a sustainable long-term, you know, business model. We like the blend, but that's very personal to us. I know that different BNPLs have different flavors. The blend also that gives you another benefit, which it gives you this, you know, network effects. So a customer will come on one merchant and then shop around. And what we found during, for example, the COVID time, when risk was, you know, the biggest thing on all our minds, is having this blend was really powerful from a portfolio management perspective. So we could switch off the riskier segments and just focus, for example, on EdTech, which is extremely low risk BNPL, and keep up our volumes, keep up our revenue, but not have to take undue risk. So we do think that this diversified model, but being a pure play BNPL is the best way to create, you know, sustainability. Another question we get asked a lot, I'm sure this is a question some of you have, why not do white label, right? So if Amazon and Flipkart are going to do their own pay later, why not just be a white label? There's a bunch of companies in the rest of the world. I think Bread was a quite big recent acquisition, but that's a good example. So Bread was the US white label BNPL, the most famous one. I think they got sold for $500 million. Affirm, which was launched around the same time, was the branded one, and you know, they're 30 billion IPO. So we do believe building the brand has value. It's back to that, you know, Bajaj point. Why has Bajaj got a virtual monopoly in the large format retail electronics? Because of the brand. You will recognize the brand. So we think the brand is really important. We've also discovered, because we've done our own experiments, we have done some white labels. So we have a couple of white label programs live, and we find that our collections and credit risk experience is much worse on them. It's meaningfully worse. And I think it's because, again, customer doesn't really care as much about, say, pissing off Paytm as they do about a credit provider that they know they might want to use again on other merchants. So we prefer branded. We think branded is much better risk and much better long-term value. And then it also gives you the opportunity to cross-sell things like a personal loan or other products down the line. So that's just our take. We also believe that omnichannel is essential. I'll be honest, when we started, we said we can build a multi-billion-dollar business just in online. As we've gone along, we've learned that our customers wanted us offline. So that's why we had to go in store. Think about your own behavior. I'm sure you all do, you know, a huge amount of transactions online, but when it came to buying like an AC or television or whatever, there was that time when you wanted to go in a physical store. And so why should we not be there when the customer wants us? And then we also found that for the brands, particularly OEMs like Xiaomi, an example here, but also Apple, they were so much more excited about an omni-channel player, because Bajaj is really good at offline. There's some other competitors going online, but nobody was trying to be, equally attractive omnichannel. So that was a real USP. We're now growing insanely fast in offline, and we didn't expect that. Actually, it's taken off quicker, faster than we expected. Within less than 12 months, we are 10% of Bajaj's volume in Karnataka, for example, and that took them 20 years to build. So the demand for a digital offline Bajaj is very strong right now. And we think even that standalone is a big, big opportunity. And by the way, we could never cater to all of that, right? We can only do, the certain regions and stores and categories that we like. So again, there could be 2 or 3 just pure play offline BNPLs built in the next couple of years, we believe. Final point, I guess, or the main point, please don't forget this. In the long run, and this is something I remember, so when I was at Goldman, and then I followed my boss from Goldman to this endowment, and he was one of the best banks analysts in the world. He's now dead, sadly, but he'd been a very famous bank analyst and investor for 20 years. And his motto of investing in banks was, just don't fuck up. Basically, it's a long game. Banks die every year by doing stupid things. We see it ourselves. Think of all the last few famous blow-ups you've seen. And actually the winner is just the one that consistently doesn't do anything really stupid. So that's really boring, but it's the truth of lending. Lending is easy if you don't fuck up. Simple as that. What does that mean? You have to really, really, really invest in your credit risk management and collections infrastructure. On day one, the first person we hired was our head of risk, our chief data officer. The second person we hired before we hired any engineer was our head of collections. And if it wasn't for that, I don't think we would be here today. Many, many, many players in our space have lost a lot of money. It's fine, I guess, if you can raise a lot of money, you can think of your credit costs as an acquisition cost, but in the long run, that doesn't work. Capital markets won't give you capital. Public markets will not allow mess up in credit costs. They will allow messes in OPEX. They will allow messes in other parts of your unit economics, but credit costs over time has to be a positive improvement. We just spend a lot of time, effort, energy, money on building best-in-class underwriting, line management, meaning how much credit do we give to each person at each time, and then collections. And we would say that it's almost impossible to scale up if you haven't got all of this in place. So, again, from a sort of VC perspective, throwing money too early in a company's credit journey is probably not going to end a good way, because you can't speed up a 30-day repayment cycle, no matter how much money you throw at it. That's just a law of time. Quickly cover unit economics and then we can get to Q&A. So this is what we believe. We believe that the sign of a really good quality BNPL is a massive amount of merchant fee in your revenue profile. That's what defines all the global guys. I think in Afterpay, it's like 85%. Affirm, it's like 75%. We're at 70%, which is really good for India, but we think it should be. Brands need these products, so why should they not pay? Apple have 90% margin on their phones. Why should they not pay us 10% or 20%? So we would say be very suspicious of BNPL companies that have not cracked merchant take rate. In the end, it's the only sustainable revenue driver. What you find in India right now, and I won't name them, but it's a few payments companies that have gone into this space without building the merchant value prop. And what they're doing is making most of their revenue from late payment fees. And I would be very suspicious of that. I think that the customer and the regulator will eventually make that unsustainable. So late payment fees is why people turned away from credit cards to BNPL. If you just replicate that model, in a new guise, it's not going to be sustainable. So we are very suspicious of that. We do think though you can charge the customer some interest rate, some processing fee, because we're adding a lot of value and customers will pay for that. So look at the revenue breakdown. That's really, really important. And if you just see so much emphasis on things like late payment fee, be suspicious. Okay, just finally, this is what our unit economics look like. I think they're very, very healthy. I've just put it into like annualized numbers because that's just easier to understand, but obviously the velocity in our products is much higher than that. Our most popular product is a 3-month product. But just for simplicity, I put this as a sort of annualized view. Basically, we borrow money at 14%. That's our funding cost. That's quite high. It should go down, but you do find that the smaller the ticket, the higher the velocity, the higher the funding costs are generally in this market. We have some deals at like 10%, and those will scale over time, but the kind of mixed pricing today, it's actually about 13.5%. But anyway, that's a rough kind of funding cost. It will be as high as like 20% in some cases, depending on scale and risk. But we managed to get an overall gross yield of about 36%. So you can see already that that's really, really attractive unit economics. Obviously, from that, you've got to take out your costs, which we can talk about. But again, look at that breakdown. What you should see is a really healthy amount of interest rate from the customer, a healthy amount of merchant fee. This is a bit confusing because obviously you get your merchant fee upfront. So from an NP fee basis, it's a much more powerful piece of revenue. Your customer interest rate is over time, so it doesn't have as much of that kind of upfront value. But you can get to really, really nice, revenue profile. Costs, obviously, within that is going to be your credit costs, your marketing costs, your operating costs. But you can see it's very easy to make a profitable business. And I would be really alarmed if you're looking at a BNPL company that's way off profitability. We are profitable on every loan today. We make a couple of percent margin, and we should. So it's only our fixed kind of overheads that make us burn money. I don't understand how you can have a net margin negative BNPL company. If lending is the root of all profitability for Indian payments companies, then how can you not make money, right? So be alert, be suspicious to that. But I've also put that in the context. So then what I've done is like NPV, merchant margin. This is sometimes called net transaction margin. So it's kind of like your net take rate on every transaction. And if you look around the world, you can see that actually Zest is already like one of the healthiest in the world. And by next year, we'll be one of the healthiest in the world. So this is, again, my kind of sales pitch on Indian BNPL. I think we have more pricing potential to the merchant in this country than in the Western markets. And so again, there is no excuse for an unprofitable BNPL in this country. There is enough kind of pricing power, if that makes sense. This can be a high margin business, and it's probably one of the only high margin payments businesses that exists. So, demand that in your BNPL company. It's really important. I've also put the mix of merchant revenue to customer revenue, because as I said, what you find in the rest of the world is a higher valuation premium, the higher the percentage merchant revenue, because that's considered stickier and more stable than customer revenue. So that's just a kind of framework for thinking about how to value a BNPL company. By the way, they typically trade at a multiple of annualized GMV. That's why I mentioned that GMV number. Afterpay trades at like 2x. Affirm trades at like 2.5x. And then the others will trade like around 1 or 1.5x. It depends. So you get a premium for percentage of merchant GMV and gross margin. And then finally, I think we already covered this, but why does specialists scale faster in the rest of the world? That's also played out. Oh, and that's it. Okay, fine. Q&A. I've been talking too much. Sorry.
Hi, Lizzie. Thank you so much. That was an amazing masterclass. So many notes I've taken. One question on my end would be, what would we look on the collection side of things when diligencing their collection processes as a BNPL company? What should we be looking in that side of things?
That's a brilliant question. And it's like the dirty, face of fintech. Nobody wants to talk about collections ever because it's considered really, really unsexy. Look, I think in the early stages, what I would look for is, first, are they just taking it seriously? Do they have a serious in-house collections team? Collections, in our experience, cannot be outsourced. There will always be a percentage outsourced, but you must have a strong in-house capability. And I think they need to have hired a couple of heavy hitters in the early years. Otherwise, it's going to be very hard to even build the framework. So the way we did it, we actually paid well above the odds. We got a guy who was like the zonal head of HDFC credit card collections for like South India, really expensive guy. We put him in a room with a product manager and we just watched what he did. And he did everything on Excel because that's how collections works in banks. And then we got the product guy to kind of study him and then build product around that. So we slowly built a completely automated tech stack around collections. I would say that's like the only way to do it, honestly. and you need to see that they've kind of taken that piece seriously. What a lot of companies do is say, well, let me get a year of data and then I'll build collections. It doesn't work like that. You need that loop, the feedback loop between the collections team and the risk team is probably the most valuable piece of the business. So if they haven't invested from day one in the collections team, then the risk models won't be built properly. As they scale, it's absolutely fine for them to have outsourced agencies. I would look at the breadth and depth of their setup. So they need to, if they're covering Pan India, they need to have, you can't shortchange collections. So the irony is we can have, most of our product business, everything else team sitting in one little office in, Coromangala, speaking only English and a little bit of Hindi. When it comes to collections, we have people all over the country speaking, 12 languages, all our comms are in 12 languages. Like they have to have built that breadth. Otherwise, it's just a bit of a story. It's not reality. In terms of metrics, the questions you need to ask, I'd say the key, like leading indicator of good risk management and good collections management is what's called bounce rate. So bounce rate is basically how much comes on due on the due date. Prevention is better than cure, as you should know. And so if their bounce rate is low, then it means they're doing a lot of work on the whole like repayment cycle, incentivization, communication, et cetera, which is ultimately the best way to manage your collections. So the credit card industry right now is at about a 24% bounce rate in India. It's still quite high because of the COVID kind of lag. I would say, and fintechs claim to have all sorts of rates. Ours is at about 6.5% right now, bounce rate. So on due, what we don't collect is about 6.5%. I think that's very good, but I'd say anyone below 12% is doing a lot right. Then you start to look at how quickly they can cure, right? So if 12% has not come on that due date, ask them how much comes in the next 5 days and 30 days. I'd say beyond 30 days is almost irrelevant. You get very little back on a BNPL or a short-term product. So I'd say in BNPL, prevention is as important as cure. So see what they've done there, and then look at their roll rates and what percentage goes from bounce into the 30-day bucket. Is that helpful?
Awesome. Thanks so much.
Lizzie, first of all, thank you so much for an amazing primer. I think you have not left a lot of questions unanswered here. But like you said, success of a BNPL will largely depend on how widespread your merchant base is. So can you list a few factors that merchants look at while they are evaluating a BNPL partner?
Brilliant question. And this is really, really important actually, because it's a bit more complicated than like even I have explained. Let me just quickly pull this up. Yeah, okay, so this summarizes some of them. I'd say, first of all, it's really basic, but your product and tech has to be, exceptionally good. You are normally integrating on the checkout. With Amazon, Flipkart, all those brands, we did direct checkout integrations. It's a huge sign-off process to even get on their checkout. With Amazon, it took about 2 years. Seattle have to approve every, checkout integration, because whenever you integrate on the checkout of a merchant, there's a risk that you can bring down the system, right? The checkout. And that's the most sensitive place of an e-commerce. So I'd say it takes a lot of just hygiene to even get to an enterprise solution that's good enough to integrate on the checkout. What you can do, and what a lot of BNPLs do now, and we do, is integrate on the PG, so kind of take an indirect route. So integrate on Razorpay, cash-free, pay you, and then they integrate with the merchant. But even to get the PG integration, you have to have very, very robust technology. Again, they will look for your, downtime, how secure your data servers, etc. So I'd say step one, you have to be really good at building like enterprise payments tech. So again, if you're looking at a company that wants to launch BNPL, but they don't have that kind of DNA, that's alarm bells, because they won't be able to acquire merchants. Merchants then, so I'd say that's hygiene, then they start to look at what is your conversion. Now, conversion in a BNPL is linked to your risk model, because it's all about how many customers you can approve. It's also about how nice is your UI, UX, etc. But I can tell you from years of experience that your risk model has a bigger determinant of your conversion than anything else, right? So KYC and things like that are pretty ubiquitous across the board. Everybody will have similar conversion funnels for things like KYC or sign up. but your risk model and how accurate it is will determine your kind of delta in conversion versus another player. So the merchant will look at that. If it's a sophisticated merchant like an Amazon, Flipkart, Myntra, they will do things like a overlap analysis. So they'll look at your customers, how many would you approve of their customers, things like that. They'll do those types of analyses. So conversion is really, really important. That's why they're using a BNPL. Then the next number will be average order value. So they're going to look at what is the impact of adding, say, ZestMoney versus a debit or credit card transaction. So Myntra is a great example. We are 130% larger than their average transaction size. So meaning if it's like 2,000, we're like 4,500, right? So it's a meaningful uplift. And that, I'd say, that's not what gets you on the checkout, but that's what keeps you there and makes them invest in you. So why does Myntra put our logo all over their homepage when it's the end of reason sale for free? Because we give them that massive AOV uplift. And we're really seeing a lot of demand from direct to consumer brands right now. I think that's going to be a huge growth space for BNPL. And direct to consumer brands, as you guys probably know, one of their biggest problems is average order value. So people might love the brand, love the product, buy like one lipstick, but they're not going to buy 3 lipsticks because they're too expensive. And so BNPL is really powerful for getting that average order value uplift. So I think that's a really key metric. I've put there an example in EdTech. There it's just going to be percentage approval, because in an EdTech, you're almost like a payment solution to them. They need as many of their customers to be approved as possible. So EdTech has a slightly different lens. One interesting one we found, and this might be specific to us, but we sell ourselves to OEMs, is on the percentage of new to credit customers that we can bring them. And the reason this is becoming so important is, especially in electronics, there's a kind of pool of credit card customers that they've all tapped out, right? So you've probably seen when you see like an ad for Apple or Samsung, they'll be like, use your Citibank, HDFC, whatever cards. That pool isn't growing. And so if you're Apple and you want to tap the next 50 million or 100 million people, you need a finance partner who can approve new to credit customers. And we give them that data. So every month we will send Apple, Samsung, these guys, what is the percentage of new to credit customers we've approved? And they track that. They really, really value that. Now, that is one of the negotiation tools we use in the take rate discussion. So they give us a higher take rate for new to credit customers than they do for like a credit card customer, which makes sense if you think about it, because it's like an incremental transaction that they may not have got if we weren't there. So that's when it gets very sophisticated, because you get into data sharing. I'd say just maybe a sort of overarching point as well is they really value the relationship as well. So sometimes, we might not be the biggest, like I'm sure Bajaj is much bigger on Flipkart, the Bajaj card, than ZestMoney, but they give us more space on the checkout, more space on the homepage, because they just like us. Like, we've always been really good at keeping up the relationship. We send them tons of data every month. We send them so much data, like more than Bajaj or anyone does. And I think at the end of the day, they really value that. So I would say, again, from a VC's eyes, if you're looking at a BNPL company, they must have a really, really good approach to enterprise account management, because it's quite easy to acquire merchants, but it's really hard to grow them and scale them. And I think, and I know actually IQ have a EdTech one, but like EdTech is a really good example. It's a real relationship business, and you need to have a founding team and a sort of enterprise sales team that are really, really, really good at keeping up the relationship with the EdTech, because that's your source of GMV, that's your source of customers. So I think don't underestimate the importance of, their ability to not just sell, but manage, long-term enterprise relationships and negotiate, right? So their commerciality in constantly increasing the take rate and MDR that they get. Yeah. Does that help?
Thanks so much, Lizzie.
Lizzie, India is generally perceived to be a low MDR market, but clearly we can see your unit economics. But what are you seeing with the offline merchants? Do you see this behavior replicated offline as well?
Yeah, no, it's true. It's funny, this MDR. So we actually don't call it MDR. So we call it marketing fee. And I think that's a really important, even just like mental shift. What we sort of present to the merchant, including the offline retailer, is, we're a marketing partner. We're going to help drive revenue, drive GMV, and this is the price of that. I think if we got tagged to MDR, it would be really difficult to justify these kind of take rates. What we do at offline though is we break it down. So we say, like, the Reliance digital example is a good example. It's a three-way relationship always between Reliance, Zest, and the OEM or the manufacturer. So in every case, there will be an agreement between, say, Apple, Reliance, Zest on the plans, the pricing plans that we're going to put out. And we normally find that we can get really, really high take rate from the brand, the manufacturer, and obviously much, much less from the retailer. Retailers will only pay, what they can get away with because their margins are relatively thin. The other complexity as well is that in offline, we have often a payment processor in the middle, like a Pine Labs or an EasyTap, and they set the pricing to some extent. So it's hard for us to push them too much, which is why it's so important to go directly to the manufacturer as well and get that relationship going. But I would say, good warning here, it takes a long time to get the brand relationships going. It took us a couple of years. It wasn't easy. So we had to suck up a bit of loss, in the early days, because we could only get MDR, to your point, which actually in the early days was higher. We could get about 2% MDR, even that's coming down because of UPI. But the big lever for us is now getting that three-way situation going. And we're now doing that online as well. So on an Amazon, we'll get, an Amazon-like MDR, which is not great. We'll get a little bit of what we call affiliate fee from Amazon. So just from bringing them a customer, they'll pay us an affiliate revenue. And then we get a good chunk of brand fee from, say, Apple. And that's the way to make this, a really attractive unit economics, in my opinion. But yeah, again, I would be suspicious of a BNPL who say that their entire revenue is coming from MDR because, and everyone knows, because of UPI, blended MDRs will continue to come down, in my opinion.
Lizzie, you talked about, if I can ask a question, you talked about how merchants evaluate BNPL players. Can you double click on how you view different merchant sectors? And you talked about it in the presentation, and you mentioned that EdTech is one of the safest ones. So how do you view that, and how do you look at the split for a BNPL company?
That's such a good question. I've never thought about it like that. And could you be a pure player, right? Like, because I obviously made the case for the diversified. I think it's always going to be a balance of, like everything in VC, of growth versus profitability. Okay, so EdTech is a lovely channel. It is profitable for us because it's got really low credit costs, really low operating costs, really high ticket size. It ticks all the boxes of how you create a profitable lending business, but it's not fast growing. Ironically, we all know Baiju's is, but we don't do Baiju's. But outside of Baiju's, classic EdTech is not fast growing enough. It's not really high velocity. And one big challenge with EdTech is it doesn't have high repeat rate. It tends to be like a one-time or annual transaction. And what we find is to really make a customer high LTV in their BNPL business, you need about 3 transactions a year minimum. And we have some channels where we get 18 transactions a year. So I'd say EdTech is nice to have, but I personally wouldn't build a whole business around EdTech, or at least it wouldn't be a fast growing, high GMV business. Electronics is the most obvious low hanging fruit. But then if you're going to play online, you've got all these complexities of working with Amazon, Flipkart, because they frankly dominate the electronics market. So if you're a pure play electronics BNPL, you need to be omnichannel, in my opinion, to get that diversity. The one that I think everybody is ignoring and has the highest potential, and where we're seeing the fastest growth rates, is what we call fashion and lifestyle. And this includes all your D2C brands. The aggregate GMV right now is low. You probably all know what it is, right? It's not that high. And obviously Myntra and Nykaa still dominate. So even for us in that category, Myntra, Nykaa are like 65%. So they're still very, very big. But the D2C guys are so desperate for GMV themselves that they will kind of over promote BNPL, and they'll be much more conducive to like sharing data, sharing customers, doing promotions. So I'd say for that reason, I really like fashion and lifestyle, because it's got the potential to be fast growing, high GMV and profitable, because you can do low CAC because of that. And we see really good risk on that. The only challenge is, it's quite ironic, but women are really hard to underwrite in India. Most women don't have PAN numbers and income and stuff like that. So there's this, we call it the housewife problem, but you have to find a workaround so that you can underwrite women, because they're the biggest drivers of fashion GMV or fashion lifestyle D2C. The other one that's not talked about enough, and I think there's an opportunity even for a standalone, is travel. Travel is very profitable for us. It's quite risky. It took us a long time to build the risk model. And I know a few people that have lost a lot of money in travel. But once you've got the model working, the algo, it's a good segment. The brands, again, are really, really good. So I think to maybe make bigger picture way of answering your question is, look for brands and segments where they really need BNPL, right? They really need it to supercharge their business. And I think if you just look macro picture at India right now, for example, travel is a great example, because it's such high ticket size, it's so unaffordable, but there's so much consumer demand. So the travel guys know that. They know they could convert more customers if they had a BNPL offering. And the offline world almost has BNPL, like small local travel agents will give people delayed payment. So the online guy has to compete. So that's why we get really good support from the merchants. What do we not like? So yeah, I'll be honest, EdTech is actually degrowing for us, just because it's not growing fast enough versus others, and it doesn't have that LTV repeat rate formula. We've learned from investor pitches and working with investors that they really value CAC to LTV, and EdTech doesn't really stack up because it just doesn't have that repeat rate. So I think that might be one where you want a specialist player. And we don't like Byju's. I'll be honest, we had a really bad experience. We don't like anything where there's a middleman and a risk of fraud and mis-selling. And I'm afraid a lot of that. So Byju's, I'm not singling out Byju's. I'm saying that segment of the EdTech market, right? That whole, K-12 segment is very high risk. So we walked away from that. Obviously, other high risk segments are things like used goods, used bikes. And I mean, it's pretty obvious. Think of any. So, we don't do jewelry. We did jewelry once. We got completely attacked by fraud. So you have to just use your common sense and think about what a classic, havens for criminal activity, and avoid them. But yeah, otherwise we pretty much do everything. And I think I mentioned it. We don't love the small ticket. So we do big basket and a bunch of like food. What we found though, the Swiggy, Zomato, and that type of segment, you actually almost, I think Swiggy and Zomato are going to become Google for fintech soon, because they charge you so much. You end up spending so much money to get transactions there. They expect you to give a 10% cash back, 20% cash back, etc., funded by the payment company, right? So you end up just losing so much money, but you do it just to tick the box and get the visibility. But I can't see how you can build a scalable business on those categories.
Hey Lizzie, this is going great. Thanks a lot. Maybe I can squeeze in the last question. Over. So Lizzie, we spoke about this today morning. What should be the right expectation from a BNPL company, or in general a lending company, right? I mean, because we are in the era of unicorns in the first year, second year, third year, right? I mean, I don't think lending companies can meet those kind of expectations, right? What would be realistic expectations, and what would be the end game of a lending company?
Yeah, this is like the perennial question. And I don't know if I am the right person to answer it, because we've not really played the game. I mean, I think the problem is we were coming at the problem statement from a very fundamental perspective, which is what I've tried to explain. We think credit is broken in the way that it's delivered in this country. We think that it could be done in a much better, more inclusive way. But we think the way to do that is a long game. It's going to take probably 10 years to build the right infrastructure before you can even scale to the levels of, say, a Bajaj. Obviously, what investors want to see right now is something very different. They want to see fast GMV growth. Or fast user growth, right? This is a DAU market. That's why investors come to India, and they'll take negative profitability to get there. It's just we've never seen how that works out in the long run in this category, because at the end of the day, you're not just losing a percent in terms of like low MDR or giving up cash back. You actually potentially lose everything, right? This is lending. And it's really hard to see how you can ever say, I'm good at something, but lose 50% of your book every month, right? And that's what we've seen in some competitors in our space. We saw one company come, I won't name them, but they managed to blow up $100 million in 6 months. And you know, what's clever about that, right? It's so obviously not a sustainable model. So look, I'm the worst person to ask because we are playing a slightly longer game. I think our goal is to be a better, bigger digital version of Bajaj, which isn't a crazy aspiration. It's one of the most valuable or highly valued companies in the world. I mean, Bajaj actually makes a firm look a bit amateur, actually, right? Because they've sustainably improved their profitability and valuation every year for the last decade. You haven't seen that in any of the Western guys yet. None of them are profitable. So that's our aspiration. That's our dream. And we think it's completely possible because we know 20 things Bajaj doesn't do very well, and we know that we can do them better. So that's the game we're playing. I think public market investors will reward that. But we have to get to the public markets, which is probably going to take us another couple of years. And to do that, you have to court growth investors. And right now, growth investors only want growth. They only want transactions. They only want users, and they don't want profitability. So we're not flavor of the month, but I'm afraid I still believe in the long run, especially in lending, cash is king. You've got to make money, right? I don't see how you can be a lending company and lose money, but I would love your views.
Yeah, totally agree, Lizzie. I think, I mean, if I look at it, the best way, what's the best way to play education and edtech? It's BNPL. What's the best way to play D2C brands? Frankly, we've done a few, we've had a share of our D2C brands, but I feel that D2C brands are best played with BNPL, frankly. If you really want to.
Brilliant.
Because that's how you want to play, right? Also, like for example, India is going through a full transformation of 24/7 electricity, right? Which basically means that every rural household can now actually, it's viable. It's viable to have a
TV, to have an AC.
Refrigerator, right? TV is okay. TV you can switch off, but refrigerator you can't, right? AC you can't. I mean, it needs electricity perennially, right? And I feel that the consumable durables in the entire rural household, right? I mean, it's going to be reprogrammed the next 10 years. And if that's going to happen, it's all going to be driven by BNPL. Bajaj probably will do part of it, right? It's a great stock to play, of course, right? I mean, I think that Bajaj should be a part of every VC's portfolio today.
Totally. It's an amazing company. But they can't, by definition, they can't underwrite 200 million households. It's not viable.
They can't, right? I mean, they can't, and neither will RBI allow them to do that, right?
Yes, exactly.
The interesting part is that there is no credible number two really established. I mean, like nobody said, okay, if Bajaj is like 30% of the market, somebody has 10% of the market, nobody has like 5% of the market also. There is no number two with Bajaj. Like, I mean, we love the market, and I do feel that it probably have just BNPL probably should have 5-10 unicorns, and listed companies. And I think it's just a matter of time. I think we continue to see people who talk about lending as a feature, as lending as the only monetization. They are doing much better in terms of valuation in the short run compared to people who are actually doing lending, right?
Actually lending, exactly.
That's okay. I mean,
exactly.
That's okay. That's short term.
Yeah, I hope so. We'll see. But no, to be fair, I think as an industry of digital lenders, if I just look at it like that, we haven't told a great story, and we haven't done a great PR job. And I think that's really stupid. It's a bit of an own goal. We should have been a bit more organized from the beginning, because we've just got a bit of a bad rap. So in a way, BNPL is a great way to kind of rebrand the industry, which is why everybody is suddenly a BNPL. But I think we have to be discerning. And that's why I'm trying to say, like, look out for these things, because anyone can say they do BNPL, but what is the real definition of, say, Bajaj, it's that they've created really incredible business models. And I don't think, especially in India, there's any excuse for not creating great unit economics in this business, right? To your point, there's so much demand from the merchant, the manufacturer, the customer, even the regulator. Actually, RBI would love this type of lending compared to unsecured personal loans. So there's like enough stakeholders that want this business built properly. I don't know why there aren't more people backing that, actually, in my opinion.
Well, things are changing now. I think, thankfully, at least BNPL is back in favor, if not lending in general, right? I mean, I think you're right. I mean, that's probably a good cue for everybody to rebrand as BNPL instead of lending.
Yes.
So,
Love it.
Lizzie, I think we should wind up. Thanks, guys.
Thank you. It was really fun. No, thank you. I enjoyed.
This was a great class, Lizzie.
Yeah, no, great questions. Thank you so much, everybody. And let me know if you need any follow-ups or anything. All right.
Thank you so much.
Take care.
Thanks, Lizzie.
You.
Thanks, everyone.
Bye. Bye-bye. Have a good
Thank
evening.
you.
Bye.